Hello, everyone, and welcome. And for many of you, I should say, welcome back. As we round out 2022, we thought it was a perfect time to revisit a topic that comes up in many of our consulting conversations, compensation design. For those of you who know us well, I'm sure your coach or consultant has broached this topic, or will in the near future. For those of you who are new to the FPTransitions content arena, welcome. We are delighted to meet you. Our team of nearly 60 professionals ranging from CFAs to CFPs spend the majority of their time focused on researching, building, and valuing financial services firms. Our guidance stems from over 20 years of working with firms ranging from 100 million AUM practices all the way through multi-billion-dollar enterprises. Today's experts are going to dive deep into the area of compensation because embarking on an intentional compensation strategy can be absolutely the key to unlocking multi-generational growth and sustainability with your firm. If that sounds bold to you, it is. But our work with over 15,000 firms to date has proven that growth happens when you set the right foundations, pull the right levers at the right times. Our experts will help you figure out when and how to do just that. I'm delighted to introduce today's speakers. Eric Leeper, CFA, partner and vice president of FPTransitions, has over a decade of experience working with financial services firms. Eric has helped thousands of owners build multi-generational businesses, and he and his team support the transfer of over $20 billion in assets year over year. Kevin Goserud, our senior analyst, who recently passed his CFA Level 3 exam, which completes his CFA journey. Kevin is one of our succession planning experts and works with hundreds of firm owners and next generation partners to ensure strategies for multi-generational growth are properly researched, structured, and executed. And with that, hand it over to Eric.
Thanks everyone for joining us today for our presentation on compensation. I'm glad to be joined by Kevin Goserud. Kevin has been a part of the FP team for almost a decade now, and has had a really good opportunity, along with myself and some other team members, to really observe the changes in the industry with respect to compensation. This is a topic which is getting a huge amount of interest, and I think if we were to look back 10 years ago when I joined this organization and started consulting to financial advisors, compensation was not very sophisticated. Our surveys back then indicated that about 90% of the industry was using eat what you kill or some conjugation of an eat what you kill system to compensate both owners and team members inside of practices. And what we've seen over the last 10 years is a very, very quick evolution of those different compensation strategies. This idea of compensation is really pervasive across all of the different issues that financial advisors are facing today with their practices. We've talked in previous presentations about the implications of human capital and how hard it is to recruit and retain talent in an industry which is actually aging. There's not a lot of new qualified talent coming into the industry, and the requirements that this new generation of financial planner and advisor have are different than the skill sets and the requirements that the founding generation of the modern financial practice had. So compensation has had to evolve to the changing labor market for client-facing service. Additionally, as we've talked about a lot over the last particularly 2 years, the mergers and acquisitions environment has changed pretty dramatically. We've seen increased interest from private equity. We've also seen that advisors who have held on to their practice through the last financial crisis back in 08 and 09, which many people on this attendees in this presentation will recall, and they decided not to sell their practice. And what's happening here is the idea that someone would sell their book of business or their practice and walk away is a little bit of a fiction. And what we're seeing from sellers is a renewed interest in continuing to work with their clients past the actual transaction where they sell or merge with another practice. So when we think about that, and that's what we call a sell and stay transaction, there's a huge compensation component that happens there. Additionally, if we were to look one layer deeper in that M&A environment, having a strong team-based compensation plan, one that makes sense and supports long-term growth of the practice and alignment inside of the firm, supports a higher equity valuation and makes those merger and acquisitions transactions a lot easier. So we've really got compensation, which is at this intersection of a lot of different issues that are facing financial advisors today. We've got a huge human capital issue, and how do we drive those resources to company performance. That company performance supports an equity valuation of the company. And then how do we then use that compensation system to perpetuate all of the different good things that we want to accomplish with the practice. We should also recognize that compensation is the largest single expense of a financial services practice. There's really no doubt about this. So while a lot of people will focus on things like getting their rent costs down, or maybe improving their technology stack to be able to provide services more efficiently to clients and profitably to clients, they often are ignoring the elephant in the room, which is compensation, which in a lot of cases takes up somewhere between 40 and 80% of every revenue dollar that comes into the practice. So it's impossible to really break down the issues that are facing financial advisors from a practice management and equity valuation standpoint without addressing compensation. And what we've seen across the industry is there is a tremendous variance in the way that firms are going to approach this issue. And in fact, we often see, as we're going to discuss later in this presentation, there's an internal variance. We often see inside of a firm two individuals who are performing very, very specific roles, but are on different compensation systems. And that can be for a lot of different reasons. That can be a legacy issue. One person came in on one compensation system, and then people maybe several years later, there was some sort of realignment, and the advisors that were working with the owners weren't able to realign the existing legacy compensation to a new model. So that's a common fact pattern we see. So when we talk about compensation, we're really looking at it from a really holistic point of view. What is the firm trying to accomplish, and how do we use the leverage inside of the compensation system to achieve those objectives?
Thanks, Eric. When we discuss compensation, it's important to keep in mind that there's no one-size-fits-all compensation solution or setup that every company should employ. But when the appropriate compensation structure is in place, it leads to several value-adding characteristics for a firm. So on this slide, we look at a few of those. So for one, compensation can be used for firm alignment and reducing or removing many conflicts of interest. So what we mean by firm alignment here is putting a structure in place which makes more of the individuals win when the company wins. There isn't a group of employees who only care about production at whatever cost to the company, while another group of employees are focused on profitability without regard to revenue growth opportunities. There's a more cohesive environment centered around the company goals. Compensation can be used to motivate key behaviors. So for example, the use of different types of performance-based bonuses. It can also be used to not only retain your current employees, but also as a primary tool for recruiting talent. And viewing this fourth bullet point, when we think about individuals buying into the company, investing for equity, it's important to keep in mind that's not separate from a company's compensation structure. Not only is the compensation expense influencing what's available for shareholders' distributions, compensation is also what's incentivizing the people of the firm who are driving company value. And the reality is, if the wrong compensation structure is in place, the company may not be very investable. And lastly, on this slide, you'll see reference to organic growth. Some examples of organic growth include increases from existing clients, so maybe through a fee adjustment or share of wallet, or organically bringing in new clients. So a lot of companies struggle to grow organically, and that's often due to compensation designs not appropriately emphasizing and rewarding organic growth. Now, before moving on, I do want to also mention that inorganic growth is often important. So mergers, acquisitions, and the company's cash flow and comp structure may influence if and how inorganic growth opportunities are utilized as well.
So, and Kevin, it's important to recognize that the idea of compensation is really diverse, right? Certain firms are going to struggle with one of these more than the other. I would say that as we go through the presentation today, you should be thinking about really what is your vision for the firm, and how does compensation interplay? And it's totally normal for the people that we work with to have a lot of questions about what that interplay is. And that's what we're trying to help flesh out with our clients when we go through our consulting process with them, is they may have a vision in mind, but are not quite sure how to get there. They maybe want to focus on client acquisition or position themselves better for acquisition. But many times what clients are actually coming to us is with a laundry list of goals, and what we want to do is try to isolate what the specific goals that we can achieve with the least amount of effort and consternation inside of a compensation redesign. So as we go through this presentation today, we're going to be presenting you with a pretty broad case study, and we want you to think about what your specific objectives are. Do you relate to the case study in any specific way? Is your business more nuanced? We understand that it's going to be very impossible to generalize every specific outcome because when we work with clients, it's a very, very individualized approach, and we need to work with what we have and where the firm is going. So as we move through the presentation here, we're going to be focusing on a pretty typical case study, as I mentioned. And what we have on this slide is, on the left-hand slide, we've got a very high-level organizational structure. But the fact set that we're dealing with here is a fee-only RIA. We call that out for simplicity in terms of the case study. We do a tremendous amount of work with advisors who do have insurance production as well as broker-dealer type production. It wasn't appropriate in this conversation to try to take on the individual specific regulatory issues. Suffice to say, we do have deep experience inside of insurance team-based compensation models as well. But for today's presentation, we're going to keep the revenue line simple. We're talking about a fee-only RIA with about $3 million in revenue. This firm has 375 households, 2 owners, which split all of the profits of the company 50-50. Partner A is aged 53 years, partner B is aged 61 years. We've got 3 advisors on staff. These are client-facing advisors that are supporting the financial planning process. It's important to note on the left-hand side, we've got 1 advisor, advisor C, is on an eat what you kill model. What an eat what you kill, just to the way we're using that term here is that advisor is taking a fixed percentage of the revenue, typically between 40 and 60% of all revenue generated. And usually there's a services sharing agreement with the firm. So they are providing the back office support and maybe a little bit of direction in the client engagement. But by and large, Advisor C effectively owns their own book of business. In addition, we have 2 support staff, which are long tenured support staff. They've been with the firm since the beginning, and we're trying to figure out how to reward them over the long term to maintain continuity and the value proposition with the client base. I want to also point out a couple of other nuances here. It is very common in a structure that we see for the 2 partners, partner A and partner B, to not take salaries, and that is the case here. And oftentimes in a fact pattern like this, we are tasked with creating a delineation between what is the actual work that is being performed versus what is the return on investment. As Kevin mentioned in the previous slide, the objective of a lot of the clients that we work with is to create an investable enterprise. And maybe that's to support an internal succession plan. Maybe that's to maximize the value in an external sale, maybe which includes private equity and get the multiple expansion from that type of engagement. But by and large, what we have to do is delineate what is the actual cost of the role being performed. And just like we would do that with Advisor A and Advisor B, and that would also inform the nature of the relationship with Advisor C if we wanted to move them off an eat what you kill model, we have to do that with the owners as well. Because if we've commingled the return on investment and the value that is being provided from the hours you work during the week, it confuses the investment thesis for the organization, and it makes all of those other transactions substantially more difficult.
So based on the case study and fact pattern Eric just outlined, what we've done here is we've outlined some potential objectives for this company. We acknowledge every company is different and has a different set of obstacles or goals, but hopefully some of these are relatable. And some of these goals are more short-term and others longer-term. So when we look through this list, the first is to improve organic growth and profitability, which importantly are not different concepts. They're connected issues. The more organic growth that's coming in, the more there may be available in the company profits as it flows down. Next, keep in mind here, we're looking to create equity opportunities and align compensation. We want to transition the eat what you kill individual off of that payout design. So we'll take a look at some options there. We have a partner looking to exit, and the firm would like to be positioned for any good acquisition opportunities that comes its way. So inorganic growth opportunities in addition to improving organic growth. So as we walk through some potential solution sets, which is where we'll turn to here soon, keep these objectives in the back of your mind and what this particular company and its leadership are looking to accomplish. So here on slide 7, you'll see these markers appear throughout this presentation. And what we're doing here is we're going to look at how changes are graded to the base case and how introducing some adjustments may change this scorecard. So we're looking at the initial scorecard based on the base case and how we would grade this company based on a few of these categories. So the first is retention and recruiting. So we have that graded as low. Some potential reasons for that would be the support staff receives only a base salary. And in this case, it's likely to be at or below industry if the company's struggling with revenue growth and profitability. When we think of advisor A and B, they're receiving salary, and we're assuming their bonus may be discretionary. So there may be no clear understanding of how and if certain contributions will be rewarded. There's also no pathway introduced yet to equity. So the current employees are probably dissatisfied in some respects, which jeopardizes retention. And without a clear and enticing structure to offer outsiders, the recruiting process may be difficult. When we look at performance, we've graded that as medium short-term performance because employees are being paid out based on their short-term efforts, but the long-term performance is low without any form of equity offered or clear vision for the future. The firm alignment is low, as many are being paid in different ways and different structures, and the complexity is medium, also due to the number of different payout structures involved at this time.
Yeah, Kevin, I want to emphasize here is that the use of discretionary bonus can sometimes increase the complexity as well, and that really ties into a lot of the other different things we're talking about here. Discretionary bonuses are exceedingly common, and they are appropriate in a lot of cases that we're going to talk about. But if you're using that as the main tool of saying, yeah, I'll pay you a bonus if I feel like it, it sounds a little flippant, but a lot of advisors are doing it in this way. So even putting even just a modicum of structure around the discretionary bonus can actually see a lot of improvements in a lot of these different areas. So we need to make sure as we move through this, when we're talking about bonus structures and things like that, that we understand how and when they're going to be distributed and how much subjectivity versus objectivity you need. We're going to be talking about that in a little bit. So as we begin to tackle the specific objectives here, I want to establish the tools that we have. And this is a very, very high level overview of the different skill sets and tools that we want to bring to bear on this. A lot of these categories are fairly simple and some of them are more complex, like we'll talk about with synthetic equity. But starting simply at the top, we start with wages and salaries, which are typically role-based. So if someone, and the easiest way to describe this is if someone is performing basically the same job function in their 40-hour work week, and that doesn't change a whole lot, that's a role-based salary. You generally would increase that salary as tenure and experience improves and the capability of the individual improves. Where that kind of starts to break down is the impact of the role and how that gets felt across the organization. And so when we move to something more like an advisor or client-facing role, it's very common to add a bonus onto the base comp. Bonuses can be structured in a lot of different ways. We're going to go into that detail in a minute, but they should be in some way tied to performance, either from the individual or to the company. As we move down, we increase the complexity even more. And this idea of synthetic equity, which is meant to synthesize the elements of equity ownership, basically in two major categories: the current income, which is effectively the dividend, and the capital appreciation. The combination of those two things would be called phantom stock. How synthetic equity is deployed it's a fairly nebulous and flexible concept. So when we're talking about synthetic equity, you can achieve a lot of really tremendous things in terms of creating both the short and the long-term incentive, but it needs to be deployed very carefully. There are some pitfalls that we want to address as we get through the synthetic equity portion of the discussion later. But it is a tool that we want to bring to bear on the different objectives of the firm. And then lastly, real equity. And real equity carries with it a return on investment. That return on investment can be the profit distribution associated with the purchase of the stock and also the capital appreciation. Importantly, with equity, we also need to make the delineation of between equity being granted or equity being purchased. And in most cases, when we're talking about equity, we are talking about equity being purchased. There are certain situations where equity can be granted in exchange for a book of business. This is called a merger or a contribution. So that's a specific nuance that we use in equity, and that is something we could utilize. For example, when someone has an Eat What You Kill book of business on the side, we can actually convert that book of business from those clients into real equity in the firm and create a consolidated vision. So it's important to understand that when we're talking about equity, there is a component to it that needs to be determined, which is how is it purchased, exchanged, or granted? And there are some tax pitfalls that we need to be aware of when we're talking about equity. So as we're moving through the presentation, these are the basic categories of tools that we want to talk about as we begin to, bring some light and some information to this client on these specific objectives.
So as we covered in the case study objectives and scorecard, there are several areas we're hoping to improve in this example. So first, we look at what we're titling Solution A, which focuses on adjusting team-based compensation, or the salary and bonus compensation tools from the prior slide. Next, we'll look at synthetic equity and equity options. But first, we're focusing on salary and bonus. And we focus here first because it's sometimes the quickest and easiest of the solutions to implement, but also because setting the appropriate salary and bonus levels is often a foundational element of compensation to which other strategies are added. So viewing this slide, the left side of this slide first, you can see how the cash flows. After the revenue comes in, there's some overhead expenses paid, and a portion of the remainder goes to team-based compensation. So you can see now under salary and bonus, both partners are taking salaries and bonuses in addition to their profit distributions. We have advisor A and B still receiving a salary and bonus, but perhaps this bonus is no longer entirely discretionary. Maybe there's more understanding and structure around the payout. We show advisor C moving from Eat What You Kill to a salary and bonus setup, and the support staff individuals are now receiving a bonus instead of only a base salary. So when we think about all of the changes that have been made, the biggest adjustment perhaps is for advisor C. The economics of advisor C, the Eat What You Kill individual, those economics are distinct from the rest. This individual moves from this entirely Eat What You Kill payout environment where they're focused on only their production into a base salary and bonus position. So recognize here that this is just one way of handling the Eat What You Kill payout individual. It may not be the most appropriate option based on their role, and we'll explore alternatives for advisor C in later slides. The important point here is that a strictly Eat What You Kill setup is typically not the best long-term compensation approach, and there are options for how to handle this. So returning to the cash flow, ultimately, then what's left, the partners receive the profit distributions. So notice here that partner A and partner B are still 50-50 owners in this solution A scenario, but how much is paid out in team-based comp will influence what's available as a profit distribution. So that's an important relationship to understand, that what's going to salary bonus, of course, is lessening or increasing, what's left to the partners. But not only that, partner A and B are part of that team-based compensation. So now they have three components to their income, and they don't need to rely only on what's left in profits.
And Kevin, just pausing here for a second, this is where we rely on the financial analysis team at FPTransitions to understand what this conversion, either from partners not taking a salary to now taking a salary on a team-based comp model, or an individual coming from an Eat What You Kill system into a salary and bonus model under a cohesive team-based structure, we want to understand what the actual implications of that are. And a lot of times what we'll do is backtest the compensation model against historical performance, either maybe just 1 or 2 years, to make sure that we're not creating a windfall for one individual under a new comp structure that is inappropriate. For example, switching someone, for example, advisor C out of Eat What You Kill, if that were to cause a 20% pay cut, that's not generally going to be a tenable situation. Similarly, if by switching partner A and partner B to a salary bonus plus profit distribution structure, creates a substantial change in their economics, it's not going to be tenable either. So this is where we rely a lot on the financial modeling process to ensure that the changes that we're making are going to stick and actually address the specific issue.
That's well put, and that's absolutely right. It really is about understanding the past and what the roles and structure will be going forward, and finding that balance. So turning to the right portion of this slide, you'll see a set of considerations. And these are really just some common areas of focus in compensation designs. Perhaps you're going to focus on one or two or a few of these considerations when designing your plan, or when we help you design your plan. But we'll walk through some of these considerations so you have a kind of a broad understanding of some of the common areas that leadership and others think about when they're constructing these plans. So the first here is client acquisition. So there could be some sort of bonus structure based on new clients in the door, so more organic growth, or some form of payout for initiating a deal, even for the company to purchase a book of business. So inorganic growth there, that could tie into some sort of bonus or compensation structure. The second there is client retention or share of wallet. So bonuses could factor in new money obtained from existing clients or clients that have been retained in general. When we look at top line, bottom line, this is a common focal area of compensation structures, and the question of whether to view revenue, more top line metrics, and or bottom line such as EBITDA or some earnings metric to determine a bonus payout or who receives what within a bonus pool. So we can look at growth or changes in margins and how bonuses should be related to that performance. Below that, and this is another really popular concept here, is how to allocate bonus pools. How much of it should be subjective versus objective? Should it be entirely objective, entirely subjective, 50-50, et cetera? So this varies based on roles and performances, and advisors with numerical measurements may be more objective, whereas individuals supporting or directing aspects of the business may be paid on a more subjective scale. So this should be set up to fit your company's goals and the people. This is very customized, as you may be gathering as we walk through some of this. Looking at attribution next, can you easily attribute performance to individuals? Right. So as an example, I recently worked with a company who had the confidence and tools to determine who was responsible for growth within a group of eligible bonus participants. In that case, a more objective set of criteria were used to allocate bonuses. In other cases, and probably more commonly, at least for a portion of bonuses, those measurements aren't available. They're not feasible. And so a greater percentage of bonus allocation was subjective. Relatedly, administrative feasibility. So can the plan be administered? You could develop the best plan, but if you aren't able to put it into action, what use is that? And similarly, it's not just about is it feasible, at what cost is the implementation of this plan, even if it's doable. And lastly, I wanted to call attention to the performance ratios. So the performance ratios can be used to check the balance of the company's compensation sources. And these ratios really look at what percentage of the company's revenue coming in the door is going toward overhead expenses, owners or key employee compensation, and what percentage is reaching the bottom line available to the shareholders. So we've seen a lot of success when these margins are about 30 to 35% for each of those categories. But every company is different, and there are reasons why recommended margins may be otherwise. So you need to keep sight of the long-term company profitability goals, as we've said, when we're adjusting salary and bonus, because everything is connected here.
Yeah, and Kevin, just as for the audience today, as we're thinking through sort of the nuances in the compensation plan and the options, it's really important that all of these considerations are related to how your business makes money. And how that happens is clients hire you to manage assets, create a financial plan. In order to support those clients, you have resources, and that's your human capital. So the interplay between your company's assets, which are the client relationships, and your company's resources are going to determine how we combine these different compensation elements to bring them to bear on a specific objective. If you have a very team-based model, the idea where you have multiple advisors or maybe an advisor and an asset manager on a single client file, the idea of attribution may become only attributable to a team and not to an individual. And so this is where we start to advance the discussion on saying, what is the highest level of detail that we can put on the performance objective? And we don't go below that. We are not in favor of creating highly quantitative systems to try to make them objective, but the inputs for those systems themselves are subjective. For example, rating someone on 1 to 5 on a scale of leadership. You're trying to make leadership an objective measure, but the determination of that metric is in itself subjective. So we don't want to confuse the issue about what we're actually trying to do here. These are not highly complex organizations, but the way they actually service the clients and the team dynamics work together are very, very nuanced, and the compensation system needs to reflect that. So once we've, so when we put a team-based compensation model in place, the idea of retention and recruiting, we've increased that. And the idea here is that by being able to articulate what the vision for the firm is and what the performance metrics we're targeting are, we can actually improve the retention of your team. They no longer have as big of a question mark about how they're being evaluated and what comes next. If the firm were to grow and I produce this result, I get a different result in exchange. And the idea that you can then articulate that vision and really codify, again, that relationship between the client and the resources of the company and how that generates performance, we can actually use it as a stronger recruiting tool for attracting new talent into the practice. From a performance standpoint, we haven't fundamentally changed a whole lot. We haven't put enough of a change inside of that short-term incentive. So a lot of times when we're transitioning T-based comp, we're trying to abide by that premise that I talked about before, which is if we were to change comp and then back test it, is one individual making substantially more than the next? Probably not. So most of what we've done with realigning team-based comp in this structure is we've created better alignment, we've created better retention and recruiting, and we've reduced the complexity of administering the plan. Remember, the existing plan had highly discretionary bonuses and one advisor on an eat what you kill. By simplifying the structure and giving yourself enough subjective and objective measures around it, we can actually move on to the next thing, which is getting more clients and moving the firm forward against its objectives. So to this point, we've really focused on the first two tools in the toolkit. That's really the wages and bonuses elements of the plan. Synthetic equity is something that has really come into prominence a lot more over the last 2 years or so. And what's driving that is firms in transition. In other words, firms that are actually going from a highly egocentric business with 2 owners taking most of the economics and trying to incentivize the rest of the team. Sometimes that transition can be a little bit difficult. It can be a little bit daunting. Sometimes you have individuals inside of your team who are not good candidates for equity ownership. This can be someone who is maybe thinking about retiring soon. A lot of times we see owners who have staffs that have a shorter time horizon than them, and they actually want to incentivize them and retain them and keep them over a long period of time. But one of the mistakes that you can make is not thinking far enough ahead on equity, which means that if you were to sell someone equity as an owner, do you actually accomplish the plan, which is to diversify the equity ownership, if that now minority owner retires before you do? You haven't accomplished the objective. You've added complexity with no real downstream benefit. So the idea of synthetic equity is really, again, to divide the different components of equity ownership between the current income, the profit distribution or dividend component, and the capital appreciation. And then we have a third category, which is a performance unit plan. So we're going to go through this really quickly. I'm going to describe the 3 major types of synthetic equity across the top, and then we're going to evaluate them in terms of their specific merits. So the first one is a stock appreciation right. Stock appreciation right is intended to capture that capital appreciation component of a compensation plan. The economics in this, they're not highly complex. There is some regulatory complexity to it. You want to make sure it's administered correctly. But the basic idea is that if I issue a stock appreciation right when the share price of my organization is $10, I issue a certain number of shares. After a certain period of time, the share price is now $15. I pay out that $5 times the number of shares that the contract is referencing. So a lot of times this can be used in situations like I described before, where you want to pay someone for the increase in the value of the company, but you don't want to encumber them with a purchase, that's, through pure equity, or maybe the complexity of becoming an equity ownership causes a change in their tax situation. So what we're attempting to do here is really structure the bonus in terms of the capital appreciation of the company. Next, we go to a profits interest or a profit-based bonus. And this does, like I mentioned before, what we're trying to simulate with this profit-based synthetic equity option is the current income component. So again, there are lots of reasons why you, as we've discussed, why you may not want to have someone in equity ownership, but you want to pay them like an owner. So we can add this, and basically what this says is that I'm going to give you a profits interest equal to 3% of the company. And what that means is at the end of every year, I'm going to give you 3% of the distributable profit of the firm, relative to that contract. So it's again, a fairly simple contract with low complexity. And then last, and perhaps the most nebulous, is what we call these performance unit plans, or LTIPs. LTIP stands for long-term incentive plan. And a lot of times with an LTIP, we're trying to accomplish maybe a combination of the different elements, or we're trying to add a longer vesting period. Basically what we see in the performance unit plan is that we create a calculation that allows a participant in that plan to accrue money against a future transaction. So this can create a really good retention tool that says, hey, I'm going to pay you this bonus. I'm not going to give it to you yet. I'm going to put it in an account, this hypothetical account. And then in 3, 4, 5 years, the accrued value of that account can be used against the stock purchase. So this could be used in a lot of cases where you're dealing with younger advisors who aren't, maybe totally ready for equity ownership, but they're very concerned about having to pay for the value that they're generating in the company. So what we do is we create a vesting period. We allow them to accrue a value against a future share purchase, so we can sort of diffuse that issue somewhat. But in order for them to get the value, it can only be used against a purchase, and they have to be there. They have to be employed and given that equity ownership opportunity at that point in time. So again, there's a high degree of nuance in how performance unit plans and LTIPs are administered and carried out, but they can be used, again, as a great retention and recruiting tool, particularly for young enterprising advisors.
Right. And a few observations to call attention to when we look at the scorecards for these options. So first, when you compare the stock appreciation rights to the profit-based interest or bonus, you'll see that the stock appreciation rights grades high in retention and long-term incentive. And inversely, profit-based interest or bonus is low in those categories, but high in recruiting and short-term incentive. And this should make sense, right? Because when you think about authentic equity, the two primary benefits are the capital appreciation and the periodic profit distributions. And so the stock appreciation rights are paying out a bonus based on the company's value. So mimicking that capital appreciation of the authentic equity. And that's more of a long-term payout. Whereas the profit-based interest is more of a short-term payout. So that would help more with recruiting and short-term incentive. And that's mimicking the owner's distributions. And then when we introduce the performance unit plan and we look at these overall scores, I mean, it seems to do a better job across the board. Of course, it varies in retention and recruiting just due to some of the complexity, but the cost of the performance unit plan in that bottom right is the complexity of it and just how highly unique they are. And sometimes there's some challenges in the actual administration of the performance unit plan. So, it does come at that cost, but one that's catered to your company needs can be worthwhile as opposed to the stock appreciation rights or the profit-based interest bonus. So now let's take a look at a solution set B when we introduce some synthetic equity options. So we're assuming the team-based compensation is still in place, but instead of paying out to the partners what remains after that expense, what we're doing is we're potentially redistributing some of that to the other employees through synthetic equity. So when you look under the synthetic equity block there, as an example, we're giving advisor A and B some performance units or LTIPs, because that synthetic equity option, as Eric described, is a lot like authentic equity. From the start, it just takes a while and you have to be with the company to realize that. For advisor C, we're looking at what if, in addition to switching this eat what you kill advisor, to remind you, from salary and bonus, in addition to that, we also gave them some stock appreciation rights. And we might do this because they're responsible for a large portion of the company's growth and revenue, thus the value added. Right. So we want them to have long-term incentive and increase the retention of this advisor C who's doing a lot of the production. And the support staff in this example, we're showing receiving profit-based interests or bonuses so that they can benefit as well when the company does well. So Eric commented on some of the reasons why synthetic equity may be used, just to restate some of those and maybe mention another reason or two. I mean, we think about partner A and B, maybe they would prefer to keep most of their equity for now. So that might be one reason why we introduce synthetic equity. The other 5 individuals in this example may not have the means or desire to buy in, or perhaps, there's a gesture to reward someone who has been at the company for a long time, as could be the case for some of the support staff individuals here who are just receiving an additional payout based on the company performance. So a lot of reasons, just wanted to rattle off a few more.
Yeah, and Kevin, really importantly, when we're talking about any mention of synthetic equity, it's very, very difficult to implement a synthetic equity or even an equity-based plan, as we're going to talk about shortly here, without first solving for team-based comp. And again, when we're talking about things like the profitability of the company and stock appreciation, particularly if we're going to be using an EBITDA multiple to actually generate the valuation and certainly to generate the value of that profits interest contract, then we need to understand really what is the normalized profitability of the company. So again, we can't actually understand what the company fundamentals are if the team-based compensation model is not correctly specified. So most every single one of our clients is going to start with that team-based comp model and then decide through a consultation with us whether or not synthetic equity or pure equity makes sense. So with solution B, remember, this is the synthetic equity slide. We've really improved the retention of this of the team through the use of the LTIP. Remember, things like the LTIP, the stock appreciation right, and the profit-based bonus only get paid out if you're there to receive it. So when we add a vesting schedule or a long time period of performance evaluation, we increase the retention. From a recruiting standpoint, particularly with respect to targeting new client-facing advisors, the idea of an LTIP does telegraph to the industry and your peers that there is an equity opportunity at the firm and that the LTIP can be used to support a future buying for the company. So we've increased the recruiting potential of the business as well. And I want to just emphasize a key point here. Advisors who are entering the business right now, this new generation of financial advisors, they are fundamentally disinterested in eat what you kill systems. They want, time and time again, when we talk to the FPA Next Gen Initiative and other organizations that are engaged in recruiting and training this next generation of financial advisor, we hear time and time again that they want to be part of a holistic team. They want to be part of a community-focused team. They don't want to do it by themselves. And while they may have business development capabilities and experience, it's not their long run. This new generation are educated in the financial planning process, and that's really what they want to do and to actually help their clients solve problems. So this idea of equity ownership is still fairly nascent in this industry, unfortunately, but it is by and large what new advisors entering the industry are looking for. So that opportunity does put you certainly ahead of your competition if you have that opportunity. With respect to performance, we've added that long-term incentive, and that's through the LTIP mostly and through the stock appreciation. So now when we're forward-looking and we're paying out those amounts based on this time period, which might be 3, 5, 7 years into the future, we've really created a long-term incentive to help grow and expand the value of the company. And we've also increased the firm alignment. When we solve for team-based comp and then we're paying people based on something which is reflective of the firm's vision and the firm's profitability, then now everyone is pushing in the same direction. Everyone is compensated in a fairly transparent manner, and they're all targeting the same objective. So again, we've solved a lot of problems with synthetic equity here, and as you begin to think about what your objectives are, we should consider how they can help solve some of yours as well, because as you know, we can't overstate that synthetic equity can be very, very complex. And that's, its flexibility is its strengths. The complexity can sometimes be the weakness, but we try to put a lid on that. Try to make it administratable, as we talked about in the previous slide.
So lastly, let's look at solution C here, which introduces authentic or straight equity. We still assume team-based compensation is in place. As we've said a couple of times now, it's such an important part of these plans and oftentimes the basis to build from. So that's still in place, but we're offering some equity to a few individuals here, as you may see. So as we walk through the cash flow, you can see we pay out the expense and salary bonus to the team-based comp. And when we go down then what's left in profits, we see under synthetic equity, we're still giving support staff A and B, those individuals, profit-based bonuses. And the reason there is ideally we would want everybody to care about the company profitability. So A and B, they're receiving their payout based on profitability, and they still have that upside in addition to their salary and bonus. In the case of the advisors, we've now changed them. Instead of having some form of synthetic equity, we're now showing them buying in. So they now have access to the profit distributions as partners. So they care about the profits as well, and they may even be relying on these distributions to service a note depending on the buy-in. Now, this presentation is not meant to focus too closely on the buy-in mechanics of how advisor A, B, and C acquired their equity, but there are various ways to structure buy-ins, which we have the resources here to help you with should you implement a plan involving straight or authentic equity. So the result of this scenario is that another objective of this case study was accomplished, in that some partner equity has been transitioned. And as you'll see when we look at the scorecard, there have been other beneficial byproducts to this setup. So instead of having advisor A, B, and C under synthetic equity, partner A and partner B willing, them offering some equity to the three advisors. That's the distinction here in solution set C, the three of them buying in or acquiring equity somehow.
Yeah, and Kevin, and just to pause there for a second, we started the case study with that Eat What You Kill advisor, and we can see that on the lower left-hand side of the slide, advisor C is now receiving 10% of equity. If equity is an objective, it can be used very, very strategically in onboarding an Eat What You Kill advisor, as we sort of alluded to earlier in the presentation. So again, as you mentioned, how the advisors A, B, and C actually came into their equity is going to be highly dependent on the facts and circumstances. It would not be unusual for advisor C to have contributed that Eat What You Kill portion of the book of business in exchange for that equity. Now, the complexity here, and again, why we lean on the financial analysis so much when we do compensation consulting, is that we have to solve the team-based compensation first. And if that team-based compensation can make advisor C whole, we may not need to do the equity contribution, and then that would convert this 10% share to advisor C to a purchase, versus if we can't solve for the delta in the compensation pre and post transaction, then advisor C may receive all or a portion of this equity in exchange for the book of business, plus being on the team-based compensation system. So again, very high degree of nuance, as you mentioned, Kevin, and something that really needs to be undertaken both qualitatively in terms of the objectives of the firm and quantitatively through the financial planning and modeling process to make sure we're going to get the result we want.
Yeah, that's exactly right. And it's not all the numbers here too. When we think about having 5 partners, there's also some dynamics, some psychology involved when we look at different equity percentages among the new advisors and among the partners. So it can become pretty nuanced, as you said, Eric, there. And we obviously want to think about all of the different components of shifts in equity.
So just scoring the pure equity solution set here, the retention recruiting still very high, right? Remember, we emphasize the fact that to attract and retain talent, the idea of equity and the idea that someone will dedicate all or a large portion of their career to the firm is very, very appealing. It also allows you to do better strategic planning as the majority owner of the firm and setting the course forward. The short-term incentive here, it varies. And the reason it varies is specifically related to the cost of the buy-in. Again, with advisor C, receiving equity in exchange for the book, the short-term incentive could be very high, versus advisor B or A and B who are purchasing the book of business. What the expectation would be is that they're using the income from the stock that they receive to basically support the cost of the buy-in through a debt instrument. Now, again, there's a tremendous amount of variability in how we structure those buy-ins. They can be short-term notes, long-term notes, variable notes. So again, that's something we need to align with the broader culture and objectives of the firm to determine what type of equity buy-in really makes sense. And of course, the long-term incentive, because we have that capital appreciation component, because we're binding them to the practice and the performance of the firm over a longer period of time, the long-term incentives can be very high. We see that in the firm alignment category here as well. And as Kevin mentioned, I want to emphasize this point again, pure equity is not simply about the economics. We have a completely separate set of facts and circumstances for equity. And the reason for that is because of the governance of the company. When someone becomes an equity owner in the company, they are accepting the rights and responsibilities of being a shareholder in that organization. And so we need to understand what the implications of that are. We need to make sure that, number one, they are going to be good partners. They are aligned economically and culturally with the success of the firm, because it is always much easier to make someone a partner than it is to take them out of that partnership. So we do need to understand and realize that that firm alignment, it can be very high if it's done correctly. If it's not done correctly, you can have a very bad day removing partners and sort of rebuilding the firm through the loss of a partner. So again, very important that when we're talking about equity, there is a gravity to it. These are very permanent structures, or mostly permanent structures inside of the financial advisory firms that we work with.
So just a quick recap here of how the different solutions were graded. When we introduced the team-based compensation to the base case, so solution A, it improved the retention, recruiting, and firm alignment. As there was more consistent structures, there was a more consistent structure in place, right? And also there was reward now for some of the value-added behaviors, just adjusting some of the bonus structures there and having everybody with the same outlay or a similar outlay. When the synthetic equity plans were added to the team-based compensation in solution B, that further supported the retention and recruiting, but focused primarily on long-term incentives, right? The advisors were given the opportunity for long-term benefits through the stock appreciation rights or the performance units or LTIPs. And lastly, when we use straight equity instead of synthetic equity for the advisors, that resulted in an additional uptick in long-term incentives and firm alignment. There are now multiple individuals who are buying in and sharing both the capital appreciation and profit distributions that come with stock ownership.
So given all the different strengths and weaknesses of all these different compensation tools, let's just take a quick step back here. Obviously, compensation, as we mentioned in the early part of the presentation, is a very wide-ranging and varied topic. The implications of setting compensation up correctly are vast. So when we're working with clients, we need to take them through a thought exercise. Fundamentally, where are we starting from? What do you have right now that is working well, and what are the gaps? And fundamentally, what is the vision you have for the firm? Are you a bunch of solo advisors trying to come together and form a team? Are you trying to replace a key role or key dependency in your firm, and you need to make sure that that's done correctly? What fundamentally do you want this firm to be, and over what time period? And then practically, what is actually achievable? What resources and competencies do you have in-house to actually support and attribute performance either to an individual or a team? And how much time and resources do you actually want to spend on administering a compensation plan? So we need to be very, very realistic when we're working with clients about what is actually possible based on the size, the number of advisors, the tenure of the people on your team, your ability and to administer complex plans. So when we work with clients, we're really trying to flesh out what the four corners of a compensation redesign can be. And to do that, we take them through basically a four-step process. The first thing we do is we have to assess, and this is where we have a number of conversations with the key stakeholders in the practice, and we understand fundamentally what those objectives are. Next, we actually consult and we design the plan. And normally this comes out in the, a written document of where we say, what are the issues that we're trying to address and what are the steps that we might undertake to actually break them down. The third step is analytics. And this is where Kevin and I are certainly going to have a bias. Over the last 10 years, we've worked with hundreds of advisors. And what we like to do is we like to show them what the practical implications of the plan are. We can't ignore the qualitative. So we establish what the qualitative objective of the plan is, and then we just test it and test it more and test it until it looks and feels right. And then we actually monitor and stay with the plan over time. And then lastly, the documentation, particularly on the equity side and the synthetic equity side, the documentation needs to be done in a manner that is consistent with all of the steps that precede it. So for synthetic equity, we're writing that stock appreciation right. For equity ownership, we're doing the contribution agreements or the business combinations through merger. We're doing the stock purchase agreements, the other plan documents, the buy-sell documents that are related to actual equity ownership. So in a sense, that legal documentation standpoint is really the capstone, and it reflects all of the consulting that came before it, and it really becomes that executable set of documentation. So that's by and large our process. I know that there are a lot of people on this call who we have worked with before, who are aware of this process, but we believe it is comprehensive and it achieves a very good result for nearly all of our clients.